everyone, and welcome to today's Interactive Brokers webinar. We're here today with Mr. Ernest Chan, who is the founder of PredictNow.ai, and he's here to present today's webinar. So he will address questions. He does have his question panel open. We also do have a handout that you can see under the handout pane. And I'm just going to welcome Ernest, and you can begin at any time.
Thanks very much, Mary, and thank you everyone for coming to my webinar. Yes, so today I'm going to talk about two topics that are highly related. One is tail hedging, and some people call it crisis offer, which is of course had his glory days in 2020. And the other topic is machine learning, which is also a highly popular topic in financial circles these days, and how the two are related. That's what I'm going to focus on. So I'll tell you a little bit about myself. Before I founded this fintech company called PredictNow.ai, which brings financial machine learning to every trader and investor in a specific way. I have been a quantitative hedge fund manager at QTIS Capital for the last 10 years. And I also have written a number of books that had become quite popular in trading circles. The first one is called Quantitative Trading. Second one is Algorithmic Trading, and the last one is Machine Trading. They have all been published by Wiley. I started my career at IBM TJ Watson Research Center in the machine learning group. That is a long time ago. And I got into the financial industry via Morgan Stanley's data mining and AI group, which was one of the early, adopters of AI back in the day. So we provided the company with AI consulting and development work and R&D work throughout the firm, not just in trading, but in all aspects of Morgan Stanley's operations. I have been, after I've written the books, you might see me on CNBC. You might see me quoted in New York Times and Wall Street Journal and Wire Magazine and so forth. Of course, before all that, I was a PhD in physics that I received from Cornell. So let's get started with what happened in 2020. It seemed like such a long time ago. It's just only 1 year. But if you remember, in 2020 Q1, we had a very, very exceptional quarter. We had numerous funds, well-known funds like Renaissance Institutional Equities was down 18% in the quarter. Bridgewater Pure Alpha Fund was down 20%. DE Shore, however, was up 7%. AQR was, depending on which fund you're looking at, is either down or up 40%. So it was a very extreme quarter with very great dispersion in their performances. Now, what can we say about that quarter? One of the particular outlier in that quarter is the Universal Capital, which is managed by Mark Spitznagel. You may not know Mark Spitznagel, but you probably know about Nassim Nicholas Taleb, the famous financial author. Well, this Mark and Nassim was, you can call it sort of a co-founder of that capital, although Nassim is now just an advisor, not a manager of that fund. But for anyone who have known Mark and Nassim, their basically call to fame is tail hedging, is crisis offer. They love to buy out of the money puts, right? That's their specialty, and no doubt they did very well. They were up 4,000% in Q1. That is the talk of the street really in that quarter. But the problem is, what happened before 2020? What were their returns? Nobody knows. Despite much argument on social media between Nassim Taleb and Cliff Asness, founder of the AQR Capital, there was no disclosure actually on how they did prior to that. But we can get an inkling of that kind of strategy, how they performed before the crisis. What I'm displaying here is the CBOE Euro Hedge Tail Risk Index. Basically a sort of average of many well-known tail risk funds, which of course Universal Capital would be included. And you can see that it was a painful drawdown since 2011. Until 2012, it was a almost 10-year drawdown. Remember what happened in 2011? Maybe some of you will remember. In the August of 2011, we had the first ever U.S. Treasury debt downgrade. That caused a week of turmoil where, intraday the S&P 500 index could have moved 5%, I think, or so. We got hit ourselves at that time, but so no doubt that's when the last time that the tail hedge funds did well. You had to wait for another 10 years before it did well again, and they still haven't recovered its high watermark. So that's a problem with tail hedging, and we want to find out how we can deal with that situation. How do we overcome this drawdown? So here I have another performance record, and that is due to QTIS Capital's tail ripper strategy. By the way, this strategy was actually offered to many Interactive Brokers clients, and these are gross performance, I should clarify. But once again, I want to caution you that this is the past performance, and it by no means indicative of future results. And we do not actually recommend you to invest in this strategy. It's purely used for illustrative purpose only. But as an illustration, it is very good. You can see that it did very well also in 2020. Maybe not 4,000%, but we were certainly up 80% growth in the first quarter. However, what this graph did not show is that we also suffered a 30% drawdown afterwards. In the second half of 2020, we suffered a 30% drawdown, and that's painful. So what is the way that we can avoid this? How can we reduce the drawdown and the risk of a tail hedge strategy? Machine learning is the answer. Machine learning can, many people thought of machine learning as being a robo-advisor, trying to tell you whether to buy Tesla today or tomorrow, whether to short GameStop the next day, and so forth. Well, if you have been reading experts in this field, such as Dr. Marcus Lopez de Prado, it is the fact that most such application of machine learning finance fail. If it were that easy to teach a machine to trade the market, well, everybody would quit their day job and doing this. Is it not as easy? In fact, we have tried many years. I've tried since my days in Morgan Stanley, Credit Suisse, and many other hedge funds, and we were failed just like many other machine learning hedge funds. It is well-known fact that most machine learning hedge funds fail, according to the expert, Dr. Marcus Lopez de Prado. He's been talking about it for the last couple of years. But there's one particular application of machine learning to finance that had worked, not just for us, but for many others. And that is using it to improve your own strategy, not to generate a new signal, but to judge whether the trading signal or the portfolio that you are already trading is going to make money in the next trade or the next period. So that's the application I'm going to focus on. How to use machine learning for risk management, for capital allocation, and for providing insights to your existing strategy, not to suddenly create a new strategy, a black box that you don't know how it works, and suddenly it starts to make money for a year and then had a big crash the next year. So you might ask, what kind of strategy can it improve? Well, it doesn't have to be an algorithmic strategy or quantitative strategy. It could be a discretionary strategy that you have been trading. It could be a fundamental factor models that fundamental managers like to trade. But it could, of course, be simple trend following strategy like tail ripper. It could be factor models. And it will, you know, if you're trading a factor model, you would like to avoid value traps, machine learning can help. And if you are a discretionary trader and you want to have more insights on, you know, why is it that you're losing money in a particular market environment, machine learning can help. Okay, so what the first output that machine learning can provide is the probability of profit. Now, many people get a bit confused. They say, okay, I know the winning ratio of the strategy. You know, my winning ratio is like 60%. Isn't that the probability of profit? Yes, that's what we call the unconditional probability of profit. It is kind of an average. What machine learning is going to provide you is the probability of profit for a specific trade for a particular environment. It is not an unconditional guess, but a condition on the current market condition. What is the probability of profit for your next trade or your next, or the P&L of your portfolio for the next day? Okay, so to get to the bottom line, is it really useful? It is useful, at least to us. We know it's useful because in 2020, as I said, we had a 30% drawdown after a glorious first quarter of 80% gain. Well, if that sounded bad, you should know if we didn't apply machine learning risk management, it would be a 40% drawdown. So that is our own experience. And that application of machine learning has been widely adopted among professionals as well, from what I understand. So that's what I'm going to talk about today. So I think I already highlighted the difference between conditional and unconditional probability. Winning ratio can be called a unconditional probability, but what we're trying to predict is the conditional probability. It is conditioned on the market condition. Well, how do we capture the market conditions? Of course, we have to create a set of predictors. Sometimes these are called features. Sometimes they are called independent variables. All right, in statistics, you understand the X variable are independent. In machine learning, they're called features. In finance, they may be called factors, or they may be called predictors. They all mean the same thing. Essentially, we need to capture this set of predictors that kind of have a good summary of the current market condition in order to predict whether our existing strategy will be profitable tomorrow or for the next trade. And that technique has a special name. It's called meta labeling. And that name is given by Dr. Marcus Lopez Dupato. I referred to him already. He was elected Quant of the Year, I think 2 years back, and he was head of machine learning at the QTIS Capital Management, and prior to that, Guggenheim Partners, and currently he is the head of machine learning at the Abu Dhabi Investment Fund. So he is the, I guess, the top expert in this field, many regard. And that label, that this technique called meta labeling originates from him, but we have put it in practice for the last year and a half to great success, I must say. So many people, when they come to machine learning, the first question they ask is, what kind of machine learning models do you use? There are simple models such as logistic regression and linear regression, and there are very complicated models such as neural networks, deep learning. Well, the first one we regard as too simple. It doesn't capture many of the complex nonlinear relationship between market variables. And the second is too complex. It has typically 20,000 parameters. In fact, one of the latest deep learning network for natural language understanding has, wait for it, 175 billion parameters to fit. I don't think that since the dawn of time we have enough data in finance to fit that kind of model. So I'm not a fan of deep learning. I might as well come out to say that right up front. And linear models are too simple. So what we use at Predict Now and what we use for our fund is random forest. It has a medium level of complexity, and it is actually widely used in finance because of that. So what is a random forest? A random forest is a sort of a decision tree. It is a hierarchical structure. You know, a decision tree is something that many people are familiar with. For example, let's say we have a short volatility strategy. It's purely hypothetical. Do not take this seriously, okay? Let's say we are only thing we know how to do is to short the fixed future, okay? You might want to ask, can I find out conditions under which shorting the fixed future is not a good idea? You might think that the level of fix is a good filter. So you can say that, well, if fix is under 15, what's happened? If fix is greater than 15, what happens? It turns out, maybe hypothetically, that if fix is under 15, 66% of the trades of a short futures trade are profitable. Great. If fix are greater than 15, then you have to look at more variables. Maybe you have to look at the one-day spider return. Is it negative or is it positive? If it is, or maybe not negative, you say, is it very bad or it's not that bad? If it is not that bad, maybe 52% of these trades are profitable. You go to the left node. But if it is really bad, then you have to look carefully for further indicators like interest rate change and so on and so forth. So these fixed value and the spider value and the interest rate change are what we call predictors. The more the merrier. These are up to you to create. You have to use your trader intuition and market knowledge and your expertise to create these indicators. Nobody else can create that for you. Although actually PredictNow.ai is in the process of creating them for you so that you don't have to, right? But so as of now, everybody have to rely on their own expertise and experience to create these indicators. But once you have these indicators, there's just a historical value of FX, historical value of the spider returns and so forth. You can use that as an input to a machine learning system like a random forest, and then it will spit out this probability. You say under this specific condition, maybe fix is greater than 15, spider is dropped more than 2%. Yesterday, interest rate change was up 25 basis points, in the recent Fed announcement, and so on and so forth. Based on this specific condition, 32% of your shortfall trades will be profitable. Would you want to trade a shortfall trade when only 32% are profitable? It's up to you. Maybe you will lower your capital allocation, lower your leverage of your fixed trade. Maybe you will stop trading it at all, right? So these probabilities are what we call conditional probabilities because they depend on these particular predictor values, and it makes a recommendation. It makes a probability calculation for you so that you can decide what are you going to do with your next trade. Trade full size, full leverage, or half it, or not at all. Now, as I said, let's look a little bit in detail just to put it in more concrete terms. The input to our system that you will have to provide at the moment are all these indicator values. Fix, if you decide that fix and one-day spider return and the change of interest rate are important, let's just take three indicators. You will have to create on every day what their values are prior to making a trade. And then at the last column, you will provide what is called a target value or label in machine learning. In machine learning, the dependent variable or the target variable or the label mean the same thing. And that typically is the future return, right? You are trying to learn from the past. So we need to know in the past, under that particular circumstance, was your trade successful? Was your shortfall trade successful? And we don't need to know the exact magnitude of return. We only need to know the sign. That's why in column E, you will see only 1 and 0. 1 indicate that that trade is profitable. 0 indicate that that trade is not profitable, right? So that's very simple. It's just classify the trade into profitable and losing trades based on the specific conditions of that historical day. And this is the data table that we need to use to feed into the machine learning system to train it. It will then learn from your own track record, augmented with these other indicators and data, to learn when was the situation, when was the market condition not favorable to your trading strategy or to your portfolio. So this is the crucial table. So let me pause for a moment. If you have any questions about the setup, please feel free to type it on the question board and I will answer them before we go on. Because this is so fundamental to our to our system. No? Okay, so let's move on then. Okay, so what do we got as the output? That's all the input, and the output are at the first output. Now, and this is by no means all you get. This is the most first level output. It will tell you for if you enter a new row of data for, let's say, today. Let's say you want to know if you are going to short fix at the close today, and today the fixed value is whatever 19, and the spider return was negative 40 basis point and so forth. You will then get a prediction. You say, okay, if you enter this fixed future trade tonight, today at the close, you will probably be profitable. That's where the 1 comes from. The 1 means that, okay, we predict it will be profitable, but what's the probability? That's more important. The probability that is being profitable is 57%, 0.57. You can use that for your leverage determination or whether to trade at all. 0.57 is actually a pretty good number in finance. You will never get an 80% probability except during extreme situation. The only time I see this probability in our own system reaching the level of like 80% certainty it will make money was in, you guessed it, 2020 Q1. In 2020 Q1, our tail hedge strategy was running so strong that the system was able to predict over 80% certainty that it will make money for many of the days. But that time did not last, right? After that, it was all back to between 50 to 60% probability, and they were right. Given the drawdown that we had, they were right. The system was right in assigning a lower probability of success. So, okay, let's see what else the system can offer. The system will also tell you how accurate it was in making this prediction in the training set as well as in the out of sample test set. As you can see, in the training set, the accuracy was of course better, 59%, but in the test set, it's lower, but it's still at the 53%. There are other performance metrics, and I won't go through them. They are standard machine learning metrics, and if you want to, it's easy to find out what they are, and we will certainly provide you with training materials on our website, predictnow.ai, how you can interpret these numbers. But these numbers are what you can use to judge whether A, your predictors are comprehensive and relevant to the problem you're trying to predict, and B, whether our random forest model is able to extract relationships between these predictors and the future return variable that you're trying to predict. So let's see, I see there are some questions. Let me answer them right now. Instead of 0 and 1, how about using the label to predict the exact return? Yes, we can. Our system can also predict exact return, but I would caution that oftentimes when you try to predict the magnitude, a machine learning system often got the sign wrong. So it is possible to ask it to predict the exact magnitude at the expense of actually getting the sign correct. It is a universal. I've seen that all the time. It never failed at this problem. Another question is, if you had a random forest in the first place as a forecasting model, do you think the forest based? No. So this is a good question. Some people said their own strategy already used a random forest to make prediction. Should we use another random forest for meta labeling to predict whether the model will work? The answer depends on the predictors. If you believe that you have new predictors that are may or may not be relevant, that are not included in the base model, you can still use random forest for meta labeling. It is really a question of the predictor set rather than the machine learning algorithm. You have to obviously use different predictors for your meta label to add value, because if you use the exact same predictors to learn from essentially learn from the error of the original random forest, that has a name. It's called boosting. Boosting is already implemented in many random forest package. You do not need to worry about meta label. That's called boosting. Yes, Mayan had a good point, namely that, well, what about the big moves? We don't want to just, be successful in predicting 1 or 0. We want to make sure that, we got the big moves right. Who cares if we got 5 successive wrong predictions if they cost us only like 0.1% return? We want to get the 2% move right. We want to make 2% return in that trade, and it's okay if we lose 4 other trades that lose us 0.1%, right? That is a very good point, and indeed you can. But the way to do that is not to predict the magnitude. The way to do that is called a technique called sample weighting. You need to weight those samples based on the return magnitude when doing the training, so that it will pay more attention on getting those large returns right, rather than focusing on getting every trade right. It will focus on getting the trade that has large returns, positive or negative, correct. So that feature is implemented in our system. You can select sample weighting based on the return magnitude already. So no problem. Thank you for that question. So let's move on and see what else this machine learning system can predict. Yeah, I think we have seen this before. Basically predict the probability. So let's see what else we can predict. Okay, here it is. Yes. So here we have summarized what we can use, we can use that probability of profit for, right? I think I already discussed that. You can use it to size your trade based on probability. And as a practical example, our own tail risk strategy called Tail Ripper, it did not enter a single trade from November 2019 to January 2020 because our machine learning algorithm detect no tail risk in that period, and it was right. My goodness, that is one of the best times during the US equity market. The economy is not running too hot. It's a Goldilocks economy, not running too hot, not running too cool. No inflation, trade war has been settled for at least temporarily, and everything looked good. Nobody believed that a virus somewhere else in the world would affect the US economy. Nobody thought that, okay? But, and so we were right that we didn't trade any tail ripper trade. It would be just a waste of time and perhaps lose money because of that. But starting on February 1st, 2020, not 2021, 2020, our machine learning system suddenly turned on our tail ripper strategy. It says tail risks are coming. Trade at full size. We were shocked because even on February 1st, certainly we don't hear any warning from the US government, at least publicly, that there was any risk to the US public health or economy, not to mention the stock market, right? So everybody was still vacationing. I was vacationing. My goodness, I was on a beach late in I was in a cruise ship in February. Had I known what a disaster the cruise ship industry will be, I wouldn't be on the cruise ship. But I was on a cruise ship off the coast of Florida in February. So, and our machine learning system was just like was recommending that we trade a tail hedge strategy. We were shocked, but we followed the advice because we have confidence in our system. So we did trade tail ripper at full size in February of 2020, and my goodness, it was a historical month. So that's what happened. That's a concrete example of what machine learning risk management can do for you. It suppresses the bad period, and at the same time, it allows you to trade it full size for good periods. But that's not all. Okay, the probability of profit is only one output. There's another output that might be equally interesting to traders, and that is called feature selection, right, or feature importance ranking. So a lot of fundamental and discretionary traders dislike black boxes, right? Even if I tell you the probability of profit is 0.57, you may not actually take that trade. We take that trade because we have confidence in this system. We have been running it for a while. But if you build a machine learning system like a month ago, you might not have the confidence if it just tells you that it is probability 0.57. What might increase confidence is to provide more transparency of why it is making that prediction. And feature importance ranking can do that job. So let's see what an example of feature importance ranking does. Here it is. So for example, looking back at that toy example of shorting the fixed future, remember we have 3 features, but actually we can have many more, right? We can have all kinds of technical indicators that we use as features. And feature importance ranking essentially rank their importance in how they go into the model, how important they are in determining the prediction. And we will provide a chart like this. These are relative importance. So all you need to care is that indeed fix is the most important. The level of fix is the most important indicator in judging whether a short-fall trade will be profitable. And then it is followed by 1 day spider return, and then it is followed by whether there's an interest rate change, and so on and so forth. Once again, please remember this is purely hypothetical. Do not think that this is actual research result. This is just to illustrate what kind of output you can expect from our system in ranking the importance of variables that can lead to a prediction of the probability of profit for your trade. Okay, and these provide a relative rankings of all your variables. Now, there's a more sophisticated version. We will see it next in the next slide. Then we take this feature selection a step further. The problem with feature selection is that a lot of time you might enter 2 different variables, 2 different indicators that are very similar. Let's say 3-day and 5-day volatility. 3-day volatility and 5-day volatility are highly correlated, but in a feature selection algorithm, sometimes it will pick 5-day as the most important variable, and sometimes it will pick 3-day, depending on the random seed, how you start the algorithm, and that can provide confusion. You know, this kind of instability in a feature ranking is what we identify as a main detriment, main deterrent to using feature importance ranking in practical investment. We have written a paper on it. Our paper was published just recently in the Journal of Financial Data Science, basically the industry premier journal on how to apply machine learning in finance. So it's published in the winter edition of the Journal of Financial Data Science. And that identified this key problem of the normal way that people do feature selection, instability in the rankings due to the fact that there are too many similar features. So what we do in our implementation is to cluster together those features that are similar before we rank them. So if you have 3-day or 5-day realized volatility, those 2 features will be clustered together and they will be forced to have the same rank, so that you won't see one time is 5-day and the other time is 3-day. They will all be either ranked as important or unimportant together. That reduces a lot of confusion and reduces a lot of instability. That result was also published. It was in the upcoming journal called the Society of Technical Analysts Journal, STA Journal. It is published, the second paper was published in that, in how cluster-based feature selection can remove this sort of instability and make this result much more usable practically for a trader and investor. But a side benefit of clustering the feature first is that the cluster can provide additional insight. For example, when we apply this algorithm on predicting 1 month ahead SPY return, spider return, it is a public data set, by the way. You can download it. If you go to our website, you can see where you can download that data set. This professor has provided maybe 15 to 30 indicators, economic and technical and whatever, the volatility and so forth indicators that he believes can use to predict 1 month ahead SPY return. We cluster those variables, and lo and behold, the result is very intuitive. The first cluster, the most important cluster that we found, are fundamental features. We find that fundamental features such as dividend yield or earnings yield and so forth are most important variables in predicting 1 month return. Whereas the interest rate variables, such as the junk bond yields, the spread between the investment grade and junk bond yields, and the treasury rate, and and so on and so forth, those are actually less important, but they are not completely useless, but they are just less important. So the technical cluster can be called interest rate cluster, and they provide great insight. Why? Because as a trader, for example, that even if you're a discretionary trader, if you're trying to hold 1 month ahead SPY, you will now pay more attention to the fundamentals of the economy rather than to the interest rate, right? So you will be less nervous about interest rate announcement and 10-year yield, which is all the talk these days. They might affect 1 day or 3 day or 5 day return, but for 1 month return, this study indicates that it's not as important. So that provides some insight even to a discretionary trader. But if you're a quantitative algorithmic trader, you would do well to incorporate some more fundamental variables into your base strategy. Because remember, this is not trying to take away your base strategy. It is trying to suggest variables to include in your base strategy. So if you find from this machine learning exploration that a lot of the fundamental variables are important, you might think about including it in your base model as part of your own strategy, right? In other words, machine learning seeks to obviate itself. It tries to provide you with insight, not to replace your insight, but not to replace your trading model. Once you incorporated all the insights that machine learning provides to you into your base strategy, you might not need machine learning anymore, right? At some point, you might not need to subscribe to our service or anybody else's machine learning service, because you have already incorporated all those insights into your base strategy. So before I go on, again, I want to see if there are any questions. So that's the question. Chris asked, how long does the strategy P&L time series need to be for meta labeling to be effective? That is highly dependent on how predictive your variables are. If you have very weak predictors, you will need a longer time series. That's generally true in machine learning. The weaker the signal, the more data you need, right? For us, we have maybe 500 to 1,000 trades, and that is sufficient to generate a good model. But that's because we have carefully curated the features. We have about 170 features now, and some of them are highly reasonable and highly predictive of our strategy success. But if you are just randomly throw darts on the wall and see, throw mud on the wall and see what sticks, and have very weak features, you might need more data to learn. Okay, so there are no further questions. I'm happy to answer more at the end, but yeah, we can move on then. Yes, so as you can see, machine feature selection in particular helps bring some kind of interpretability, some transparency to machine learning. It is no longer a complete black box. It can help traders incorporate features into their base strategy, instead of just using the machine learning model as a trusting it completely. It provides insights rather than decision for you. And but in a more quantitative manner, selecting only the important features also improves the accuracy of your predictions. So it is not just insights, not just qualitative improvement. It actually provides quantitative improvement to your machine learning model. You can read about that in our 2 papers that were just published. They actually improve predictive performance if you get rid of those useless, noisy features. Now, there is one other set of questions. I see that Mahendra, sorry if I mispronounced your name, is that how do you tell you have the right set of features? That is what feature selection is help. Basically, you should add as many features as possible. Do not be worried that, oh, some features are useless, some features are redundant. No, no, no. If you want to create a volatility indicator, throw in all different time frame, 5 days, 3 days, 1 day, 10 days, 1 month, 1 year, whatever. Be creative, be expensive. It is the opposite of parsimony. So a lot of times traditional quantitative model says be parsimonious. Remember the Occam's razor. Be very lean in your models. Pick as few predictors as possible. That is true for traditional quantitative model. For machine learning, you don't have to worry about that. Create as many redundant variables, as many useless variables as you can think of. At least 100, if not 200, 300, the more the merrier. Why? Because we are running feature selection, right? That's the whole point of feature selection, is that it will get rid of useless variables for you, so you don't have to. And that is a great way to do exploratory analysis, because in exploration, you don't have a preconceived notion of whether a variable is important, whether a feature is important. So throw it in. It won't do any harm, because if it is really useless, the feature selection step is going to get rid of it. It will put a low rank to it. As long as you have some useful feature, the predictive model will work, because the bad ones will be removed during the feature selection process. It will not pollute the model. Okay, so I see that there are more questions, but perhaps we should wait until the end. So let's move on. I'm glad that we almost get to the end. So as the conclusion, we have found that, as a specific example, machine learning has greatly helped us to reduce drawdown to the tune of, reducing our drawdown for 40 to 30%. You had a great year last year, but we had also a severe drawdown. But the drawdown could have been much worse if we didn't have machine learning. Machine learning is best used for risk management, not for alpha generation, because if it's so easy to generate alpha using machine learning, everybody would be rich and everybody would quit their day job and become traders. It's not that easy. Risk management is the best use case for machine learning. Compute the probability of profit of a trade that you're already going to make. And then finally, feature selection can help traders understand what are the important variables that you should add to your model. That provides great intuition. So with that, I think we have one more slide, and I will be ready to take more questions. So please feel free to reach out to me with any questions at ernest@predictnow.ai. I'm also quite, have a LinkedIn and Twitter. Feel free to connect in either way. And finally, you can go on to our website to have a free trial. Try it out to see how it can help you manage risk for your portfolio. Thank you very much, and I'm happy to answer more questions. So one question that has already been asked is, let me scroll back. By the way, if you're hearing this background noise, it's because working at home entail that my 3-year-old is in some other room, so I apologize for that noise. So okay, let me go to a previous. Oops, I think I've just gotten rid of the questions board. Actually, yeah, I don't know why. Sorry.
Do you want me to read the question for you? I think also if you just select the little icon, it looks like a square box with an arrow. It'll pop up a pop-up window.
Yeah, actually,
You want me to read the question?
I'm not quite able to yeah, here. If you don't mind, Mary, just you can type it on the chat window.
Oh yeah,
and I will be able to see if you just copy and paste that. Yeah, thank you.
Oh, actually, I'm just going to read it to you.
Yeah.
In practice, how problematic is it to use the same data for developing a strategy as for meta labeling, as opposed to a held out separate set dedicated to training a profitability meta labeling model? This is from Brendan. So,
Yes. So thank you. Yes, I think that in terms of data, you can use the same data to backtest. Or, suddenly my question board come back up, so I can see exactly what they are now. It is okay to use the same data for meta labeling and for backtesting your base strategy. It is not a problem. We do the same. We do the same. It is, of course, necessary to make sure that the out of sample result, the out of sample data do not overlap, right? So let's say you backtest your strategy using 2019 as out of sample data. Well, you can use the same data, same year as the out of sample data for meta labeling, right? So as long as you didn't make a decision using the 2019 data in your backtest, but and one of the decision might be to decide whether to accept that strategy. As long as you really keep that year out of sample and not using it to make any decision, you can definitely use that same year or same test set for both meta labeling and your own base strategy backtest. It's not a problem. The next question is that is candlestick data useful for machine learning? Why not? Why we should not have prejudice with regard to what data. Throw them all in. If you think that something might be useful, throw it in. Be indiscriminate in adding features. Be indiscriminate. What does this mean for retail investors? Well, our system is designed for retail investors. So all you need to do is to, many retail investors know how to compute technical indicators. They know how to compute variance, and I'm sure that there are many IB partners who can provide that data, right? I'm sure there are many partners who can pre-compute this data for you. So you can use that as an input to our system too. You don't have to create it yourself. Now, we ourselves, as I said earlier, at PredictNow.ai is also working on creating those features for you without you having to work on it. So that is our next step. Hopefully, the first round of features on US stock, US companies fundamentals will be out in the next 2 months. But for now, you have to create it for other IB partners or from your own trading platform. But going forward, it will be included in part of our platform to make it easy for you. Okay, so the next question is, why is your service better? So that is a great question, Nassim. It is not better than XGBoost in the fundamental algorithm in many ways, but if you are not a programmer, or even if you are a programmer, to put together a machine learning pipeline is actually extremely tedious and error prone. We have done it. We have a team of 5 data scientists internally at our fund. It took us 6 months to get every bug figured out and to identify the correct configuration, the optimal configuration, and so on and so forth. So even just to configure a machine learning pipeline with a free open source software takes a great deal of effort. But that is not also counting the adjustment we make to the system. For example, if you just use the plain vanilla feature selection, you will suffer from the instability of feature. But our feature selection algorithm has been preconditioned by using clustering, hierarchical clustering of the feature ahead of time. To date, I don't know any other system that use that. That's why we were able to publish papers, right? The fact that the paper are published by Reverie Journal is because we are the pioneer. If it is already well known, we won't be accepted for publication. So our system are the result of careful calibration and careful research of many subtle aspects of financial machine learning. It is not a plain vanilla, let's just make available XG boost on the website. It's not that simple, you know. So you can just look at our research to know that we have actually done a lot of fine tuning and adding techniques that is not available on other platforms. So Dory asked whether it can be used for any trade. Indeed it can, because the key idea of meta labeling is that it is agnostic to what you are actually trading, right? You just tell us if it is profitable or not. We don't need to know if it is a Bitcoin trade, or is it a Forex trade, or is it a stock trade. We don't need to know, right? So it can be applied to any trade as long as you uploaded the correct the sign of the correct return, or if you can also enter the actual return of your trade as part of the data. But you know, if you are only interested in 1 or 0, then you know, you just need to tell us if it is positive or negative. That's good enough. No, so therefore it's irrelevant what exact market you are trading.
Hi, Angel. I see you have your hand raised. If you'd like, if you want to put your question in the chat panel, that would be great. All right. Does anyone else have any other questions today, Mr. Chan? And we will. This has been a great presentation. And so this is the moment. If you have any other additional questions, please enter them in the chat or in the question panel. Oh, I see one just came in.
Yes, one last question. Okay. What was it about the February 2020 that indicated? Now, that is a very, very interesting question. We were asking about that. So, you know, obviously the features we use for the tail ripper strategy are proprietary, so we can't tell you exactly what they are. But what I can tell you is that we don't limit our surveillance of the market conditions to US variables. We have surveilling the global market conditions, and as a result, we pick up signals from Europe, from Asia, that things are not going well in the market. In February 1st, there are things are going already, you know, somewhat, things are certainly going pretty dicey in Asia and Europe, and we pick up those signals. That's the beauty of machine learning. Many people thought that, okay, in order to predict the US market, we should focus on US market variables. That's not true. You should pay attention to globally, but there's so many global signals, it is hard to incorporate into your system unless you use machine learning. You know, are you going to incorporate South Korean stock index? Are you going to incorporate Hong Kong Hang Seng index? Or what about the yuan, right? So it's you know, just impossible to incorporate them all unless you use machine learning, and that's the strength of machine learning. The predictions that we did is on a daily basis. So we are trying to see today, is it a good day to trade a tail hedge strategy? If not, don't trade it. So that's only for us. But for you, your trade might take place only once every week. Then suddenly the prediction will be covering a week. So that is again very highly dependent on your data. It is the time period of prediction is to be customized to your own particular data and trades. One more question. Maxime said it didn't grasp meta labeling versus actual labeling. If we are using machine learning for signal generation, we already know the probability of trade. Yes, that's what I'm saying. If you are already, your base strategy is machine learning, you do get a probability of whether the market is going to go up or down, right? But the meta labeling is not trying to tell you whether the market is going to go up or down. It's trying to tell you whether your long or short trade is going to be successful. So for example, if your base strategy said, okay, the probability 55% that the market is going to go up, buy SPDR. Okay, you buy SPDR, but the meta label model will look at all your spider trade and say that, hey, actually buying spider is a losing proposition. So it assigns a 40% probability that buying spider is a good idea on that day. So why is it there's a difference? Why is it that your base machine learning model will say that it's a 55% chance the market's going to go up, and that's why you buy spider, but the meta label model says that it's only 44% chance that buying spider will make money. Why? That's because of your features. Hopefully your machine learning model is using your base model, and the meta label model is using different set of features. That's why it can give you different results, right? And like I said, if you're using the exact same features for your machine learning and your for your base model and your meta label model, it's not called meta label, it's called boosting. It's well known in machine learning circles. You are trying to learn from the errors of your base model. It's boosting, it's not meta label. That's a big difference there. And then finally, there's another question. Don't you think that machine learning returns is more possible for funds who don't need as much capacity? I don't think that is a fair assessment. Yeah, I'm not sure that what machine learning has to do with capacity, frankly, because machine learning, in my view, is a risk management tool. It can manage risk for any strategy, whether it has a big capacity or small capacity, right? I think it's quite independent of the capacity of the strategy.
Excellent. I think we're at the end of the questions. I also just wanted to mention, I went under the Interactive Brokers website under education, and you'll see there's Traders Insight. And Predict Now AI has some articles on Traders Insight. So if you haven't seen them, you may want to take a look at, just do a search on predictnow.ai, and you'll be able to see those articles. Excellent. Okay, good.
One last question about swing trading. Of course, it can be used for swing trading. It doesn't matter, right? It can be used for any kind of trading. It certainly can. Yeah. Thank you so much, Mary.
Yes, excellent. Thank you so much.
Yeah.
For an excellent webinar. We really appreciate everyone's participation. And thank you so much, Mr. Chan, Dr. Chan, I should say, for a wonderful event. And thank you very much. And everybody have a great weekend.
You too. My pleasure.
Bye-bye.
Bye-bye.